Hi, everybody. Okay, so we're going to take a look at Chapter 11 here. It's going to be a relatively brief lecture because really all we're going to talk about are some general concepts and terminology. There's a lot of terminology with regards to this topic. Again, I want to remind you that if you have any problems at all, please get in touch with me. We can have Zoom meetings. I've had phone calls with several students. We text back and forth when they're doing homework. So use me as a resource. I haven't heard much from people in this class, but you guys seem to have things well in hand. I'm guessing you've got some study groups going on as well. So let's get started. Retirement plans. Why are there retirement plans? Well, number one, they receive tax advantages, and the reason we need them is because we need to save money. The average Social Security recipient is getting somewhere around $1,500, $1,600, maybe $1,700 a month. Not a lot, and certainly not enough to live on in Southern California. So we need to be putting money away and saving for retirement. Here's some terminology that we're going to need. An annuity. An annuity is, in general, a series of payments made pursuant to a contract. So you sign a contract with a financial institution and you make a payment in, and then at a certain time you start getting payments back, and you get those payments back for life. The beneficiary. Beneficiary is the person who receives the benefit from the plan. Contributions are payments made to a retirement plan, either by the employee, employer, sometimes both. Distributions is what you're getting back. A donor, person or entity contributing to the plan. Tax deferment, and we're going to talk about this. I'm going to mention it a couple of times. Now, for those of you who are in Accounting 201, you understand what deferral is. Tax-deferred retirement plan means that I'm not paying taxes today when I put the money into the plan, but I get taxed when I take the money out. The idea being that possibly the tax rate that you're going to pay after you're retired is going to be lower than the tax rate when you earn the money. And a trustee is normally the person or organization that administers a retirement plan. Again, tax deferred does not mean tax-free. Generally, untaxed contributions are taxed when distributed. Previously taxed contributions are not taxed on distribution because obviously you've already paid the tax. So let's look at objective number one, some questions. Tax-deferred retirement accounts are essentially tax-free? No, they're deferred. Deferral just means you're putting off the tax. Some are deferred, some are not tax deferred. The period in which accumulated assets are paid to plan beneficiaries is known as the distribution period. And a KEO plan, an example of an individual-based retirement plan? Not really. It's a tax-deferred plan for the self-employed. Two examples of employer-based retirement plans, well, obviously 401k for private industry, 403b for nonprofits. Distributions from pension plans are taxable if the contributions were made using dollars that were not previously taxed. Yes, that's the idea. So here are some samples of employer-sponsored plans. Here's the 401k, we all know about those, 403b, the KEO plan for self-employed, and then there's the SEP, the Simplified Employee Pension, and simple plans. Plans provide benefits to employers and employees. The employer gets the immediate tax deduction for contributions. Employer contributions are not compensation to employees. Earnings from plan investments are not taxed when earned. Plan assets or earnings typically are not taxable to employee until withdrawn. The defined contribution plan is your 401k. It pre-establishes the amount of the contribution. So the amount of the eventual distribution, though, isn't known for certainty, and it's going to change depending on when the person decides to start taking distributions. Defined benefit plans, that's your more traditional pension plan. The amount of the contribution is not known with certainty and will vary. So again, both of those things are varied. The defined benefit plan is the pension plan. That typically comes from the employer. Qualified pension and profit sharing plans. They must be non-discriminatory. There are minimum vesting rules. Vesting rules typically are for requiring that people work a certain amount of time before they start to get benefit, before they are eligible for benefits from the plan. It keeps employees working longer for the employer. Additions to defined contribution plan can't exceed lower of $58,000 or 100% of compensation. I will not be covering a lot of these details in this lecture. I'm going to expect that you're going to get these details from the chapter itself. 401k plans must meet non-discrimination rules. Employee can elect to defer up to $19,500, and if you're over 50, you get what's called a catch-up. So they add an additional $6,500 of possible deferrals. Keogh plans are for self-employed. The contribution is the lower of $58,000 or 25% of earned income from self-employment, and the earned income cannot exceed $290,000. Earned income from self-employment is after the deduction for 1/2 of the self-employment taxes paid. That typically is kind of to represent what the employer portion would be, and after the Keogh contribution. SEP plans, simplified employment. Employer creates and contributes 2 employee IRAs. Maximum contribution is lower of 25% of compensation or $58,000. You see that $58,000 is a limit in a lot of different situations here. A simple plan is an employer IRA or 401k. Employee contributes a percent up to $13,500. They get an additional $3,000. Again, you get a catch-up if you're over 50. Employer makes matching contribution of 3% for all employees or 2% for eligible employees. So this is a place where you can actually discriminate. Traditional individual retirement account, an IRA or a Roth IRA. Contributions are limited to the smaller of $6,000 or 100% of compensation. If you're over 50, you get a catch-up here too. It's an additional $1,000. By the way, catch-up means that if you started later, I should have explained that before. Catch-up means that if you started your compensation, started your savings late for retirement, it gives you a chance to catch up to where other people would be who started earlier. For married taxpayers with regards to individual sponsored plans, if both are employed and neither are covered, then both spouses can make a deductible IRA contribution up to the dollar limits. If only one spouse is employed and that person is not covered under an employer plan, they can make both. One person can make 2. Finally, if one spouse is covered under an employer plan and the other is not, the non-covered spouse can contribute up to the dollar limits if AGI is less than $198,000. Traditional IRA versus a Roth. Contributions are deductible for traditional IRA, but not for a Roth IRA. But then distributions are taxable under the IRA, but not for the Roth IRA, because obviously the Roth IRA is already using taxed income. Taxpayers are trading off the non-deductibility of contributions against the non-taxability. So 2 types of individual sponsored retirement plans are IRA, Roth IRA. A single individual, age 58, with wages of $30,000 can make a tax-deductible contribution of up to X under a traditional IRA. Well, they can do the $6,000. That's the max for most people, but then this person is over 50, so they get the additional $1,000 catch-up. So they get to contribute a total of 7. Coverdell is an educational savings account. The contributions are not deductible. The account grows tax-free. The distributions aren't taxable if used exclusively to pay higher education expenses of the beneficiary. Any person can establish and fund a CESA for any person, including him or herself. A qualified tuition plan, a QTP, is a state-based plan. We also know it as a 529. That's what you should start when your child is born. Earnings grow tax-free and can be used for qualified education expenses. Qualified education expenses, typically tuition, room and board, books, all that sort of thing. Contributions to Coverdell are not deductible. True. The maximum annual contribution to a CESA is $2,000. Contributions to CESA accounts begin to be phased out when AGI reaches $95,000 for a single taxpayer. And finally, distributions from a QTP can be used for a computer used by the beneficiary student. Absolutely. That's what it's for. Roth IRA distributions are generally not taxable. Earnings, but not contributions, are taxable if withdrawn prior to the initial 5-year holding period. Coverdell distributions are tax-free if used to pay for the qualified education expenses. You can't use education expenses paid by CESA also for American Opportunity or Lifetime. In other words, you can't double dip. You got to choose one. An annuity, again, is a series of payments pursuant to a contract. The contract typically is with an insurance company or other financial institution. You pay the money in, and the idea is the contract says when you retire, you get X amount every month. Normally, annuity payments are partially taxable and partially tax-free, which the paying institution will tell you. It'll be on your statement. The tax-free component is based on the cost of the annuity contract and the expected return. The cost of the annuity contract is the amount the recipient paid for the contract. So that's the amount that you pay in. For objective number 6, an annuity is a series of payments under a contract. Annuity payments often have a taxable component and non-taxable. That is also true. And that'll do it for us on Chapter 11. Please, again, contact me if you have any questions. I'm more than happy to help. Take care and have a good week.